That's my ex. Welcome back to Strongman Personal Finance. Did you know that I offered a very unique service? If you pay me $40 and you click this link right here, I will make a dedicated video for you on my channel. And don't forget, I'm a certified CPA accountant. Yeah! Now, I don't have to make videos just about stocks. I'll make videos about anything as long as you get my prior approval. Click that link, send me money, and get a personalized video from Strongman. In this video, I was paid to go over the financial statements of PubMatic stock. PUBM is the ticker symbol. Now, this stock reminds me of It's the Future, Bro, and you'll see in a second why. Okay, it's disrupting, it's changing, it's innovating the advertising industry, but it's a very interesting company. Let's go investigate it because I was paid those delicious smackolians. So PubMatic, what is this company all about? It provides a cloud. Let me make sure I'm sharing my screen. Good. PubMatic Incorporated provides a cloud infrastructure platform that enables real-time programmatic advertising transactions for internet content creators and advertisers worldwide. Basically, my understanding of what programmatic advertising means is, imagine you go to a website, right? And when you open the website, you see all these ads pop up. Like, I'll search for RuneScape. Like, I searched for RuneScape like 6 months ago. And I'll open a website, and there'll be a RuneScape ad there, okay? That whole process of getting that ad delivered directly to you is part of the programmatic advertising process. Basically, a bunch of different advertisers compete and bid based on, CPM, clicks per 1,000 or something like that. They bid on what ads are shown to the consumer. What PubMatic does is kind of help facilitate that process of getting an ad to an intended user and having companies bid between each other, basically. So that's kind of what this company does on a very broad sense, okay? I'm sure there's more to the company than that. But we're going to look at the financial statements, okay? I'm not an expert in the advertising industry. I just get ad revenue from my grift videos. So here's the stock. It looks like it was publicly traded December 14, 2022. So it came to life during the clown market. It massively blew up to $64.81. And now it's back down to $15.26. Down 39% in the past 5 years and down 24% in the last year. Now, that doesn't mean it's a bad stock. Just because a company stock goes down doesn't mean it's a bad stock. It's a bad stock if its underlying financials are absolute freaking trash, and they're expected to continue in the future. So let's see. Market cap, $664 million. That's a very small market cap. Revenue of $257 million over the last 12 months. And net income, or bottom line, the bottom line profit on the accrual basis of accounting, of $18 million. PE ratio, 49. Okay, this is a growthy stock with a forward PE of 22. Now, Lefebvre would be salivating over this stock, man, at least from this so far. Oh, it's profitable, and the forward PE is lower. So let's go ahead and look at the financials. Let's look at the revenue, my revenue. So revenue is just the dollar value of the sales that you have earned, the money you have earned as a company. That's before any expenses are deducted. You can't just look at revenue, my revenue, okay? You got to focus on profits as well as the whole comprehensive picture of the company. So we look at revenue, okay? Revenue since 2020 has generally trended up. It's definitely going up, okay? Now, when it comes to advertising related companies, this is it's a very, very simple concept. You're going to, and I know this because I make money from advertising. It's my side job, YouTube. The last quarter of the year, you always see a spike in revenue for these types of companies. This is an ad-related company. Why is that? It's because of the holidays. You will always see a spike in revenue. Look at this chart. You see the three big spikes, okay? December, the last quarter of 2022. Well, I can't point at it. But the last quarter of 2022, the last quarter of 2021, and the last quarter of 2020. All three of those quarters had massive spikes. So just because the revenue has gone down, okay, year over year, or, from quarter to quarter, not necessarily over year, from quarter to quarter, it doesn't mean the company's dying. Ad rates fall in the following quarter after that last quarter of the year. So that's something you got to keep in mind. Now, looking at this one, during their busiest time of the year, ad rates, their revenue was actually down. So during the busiest time of the year where they should have made the most money, their year-over-year growth rate for where it most counts was down 1.67%. Not the end of the world, but a lot of companies in the advertising industry are experiencing this kind of flat revenue growth rate. Doesn't mean the company's dead. But the revenue growth rate, where is it at? The revenue growth rate has massively declined. So right now, because of the whole, economy's bad, ad rates are down, blah, blah, blah. Well, the economy's really not bad, but high interest rates, a lot of growth in advertising has gone down pretty significantly. And as you can see, this is the rates, how fast the revenue was growing year over year. It's basically has flat revenue growth right now. Doesn't mean that's going to continue in the future, because when the ad industry comes roaring back, which it will at some point, trust me, revenue growth rates will probably go up. So I don't necessarily think this is a dead company just on the surface level, but you need to keep that in mind. The revenue has slowed down, okay? Let's look at some profit margins. Gross margin has been trending down, okay? Operating margin, that is your profit before interest and taxes. Basically, how an income statement works is you have your revenue minus your cost of goods sold, which is the cost of the item or the service you're delivering. Then you subtract out operating expenses, salaries of the office manager, well, not the office, like advertising, research and development, stuff that is not directly related to the production of the goods or services that you're selling. Those are all your operating expenses. Then that's your operating profit. Then you subtract interest, and then you subtract taxes, and that's how you get your bottom line profit. So we can see here, their operating income took a massive hit in the first quarter of 2023. I believe the 10Q I have open is that quarter. Does that mean the company's dead? No, it was probably some kind of impairment is what I'm thinking. But you can clearly see that overall margins have been going down, okay? And this is probably just because the whole ad industry is having a hard time. But margins are going down, at least for now. That's something you have to keep in mind. And their bottom line profit most recently was negative 10%. Now, their free cash flow margin has gone down as well. So they're going through a time period where their revenue is basically stalled and their profits are down pretty significantly. That's the two main things that are going on right now. We'll skip the balance sheet because it sucks on here. Let's do a broad overview of cash flow. Operating cash flow is still positive. Okay, that's good. That's always a good thing. Capital expenditures are less than operating cash flow, which is why they have free cash flow. They did an acquisition in the third quarter of 2022. What else do they do that I notice on here? Let's see. Share issuance. They actually had some share buybacks. That's interesting. And basically, they've been paying off debt. Okay. So overall, they have positive operating cash flow. It has trended down, just like their profits, but they have positive operating cash flow. So they have net positive cash coming in from their core business. So they don't have to necessarily dilute. They could for any number of reasons, but they don't have to dilute or issue shares to survive. And they have positive free cash flow. But basically, revenue slowed down, margins have slowed down. Okay. Let's look at the 10Q. Let's go look at the balance sheet in detail. Consolidated balance sheets. Now, Lefebvre calls the balance sheets. Here they call it consolidated balance sheets because this company owns subsidiaries, controls subsidiaries. And when a company controls a subsidiary, you actually have to combine them together for a presentation, even though they're two separate entities on paper. If PubMatic owns another company, controls it, I mean, you can't just buy one stock and say that company's a subsidiary. But if they control another company, it gets combined on the balance sheet. So let's go line by line on the balance sheet, and let's see what's going on here. Cash is down a little bit, nothing crazy. Marketable securities is up. That's, they're probably putting their money into treasuries, which makes sense. If they're sitting on cash, you might as well put it and make some yield off of it. Accounts receivable has gone down pretty significantly. That makes sense because their revenue is going up. Accounts receivable is money that is owed to you that you've already provided a service for that you haven't received the money yet for. And prepaid expenses is flat. So overall, their total current assets have gone down significantly, and it's mostly through accounts receivable because their sales aren't as great. Property, plant, and equipment has gone down a little bit. That could be depreciation. Operating leases down a little bit, amortization. Acquisition-related intangible assets. That's down a little bit. Nothing crazy, probably from amortization. Goodwill is exactly the same. So they didn't, over the last quarter at least, they didn't make any acquisitions, or if they did, they didn't pay over the they didn't pay more than the fair value of the net assets. But goodwill basically means they acquired other companies and they paid more than the fair value of net assets. Nothing's happened over the last 3 months for that. Deferred tax assets. This is basically differences between book income and tax income. And if you pay more taxes now, because there's differences, IRS rules are different from GAAP rules. Some things you can't deduct, some things you can, some things you can only deduct half of. With a deferred tax asset, that means that you deducted less on your tax return than you did on your books, but it will reverse out. So basically, these are tax benefits that they're going to receive in the future from temporary differences. I mean, it's not significant, but that's just what it is. Okay. And then other assets, I mean, immaterial. Accounts payable has gone down. I mean, that could just be anything. It could be a timing issue. Accrued liabilities up insignificantly. Leases. So basically, while their current assets have gone down, their current liabilities or current debts have also gone down decently proportionally. So overall, like, I don't think this company is going bankrupt anytime soon. I mean, they have positive cash flow and they have a very solid current ratio. They have plenty of cash. They have plenty of marketable securities, and their accounts receivable, which they expect to collect, is very hefty. I don't think they're going bankrupt anytime soon. Could be wrong, but who knows? All right, let's see. So overall, their balance sheet, like, it really isn't that bad. Okay, at least the asset liability section. Let's look at the equity section. So equity, I see treasury stock. So treasury stock is a contra equity account. That means a company buys back stock, it reduces the company's equity. So you'll see a negative number under stockholders' equity for treasury stock because this company has purchased back shares. It has reduced the number of shares outstanding, theoretically. So they had some share buybacks, and they spent roughly $8 million on it. Additional paid-in capital, so they had some stock issuance. Could be from stock options, potentially. Accumulated other comprehensive loss, immaterial. And retained earnings has gone down. So retained earnings goes down. Well, there's multiple ways, but generally it goes up with profits. It goes down with dividends. And there's some other ways it goes down with share buybacks, but that we don't have to worry about that right now necessarily. But basically, retained earnings is your accumulated profit and loss that it has not yet been distributed to shareholders. That's what that means. It's profits that have been retained in the company, not necessarily just sitting in cash, but put to use somewhere else. So overall, I mean, obviously stockholders' equity has gone down a little bit, but that's mostly from share buybacks. Okay, and they had a little bit of loss, and they issued some shares. So overall, the company isn't going bankrupt anytime soon. Let's look at profit and loss. Revenue. We know revenue's basically flat from 1 month to the other. Actually, hold on a minute. That's interesting right there. That's actually very interesting. Hold on a second. What? Okay, hold on a minute. For the this is year over year. I was like, this isn't the prior quarter. So year over year, the revenue has gone up just a little bit. Okay, so their revenue growth rate has massively slowed down, but their gross profit has gone down. Let's see what could have. Well, obviously, the gross profit is affected by cost of revenue. Let's see operating expenses. Technology development's up 50%, but still small. Sales and marketing is up pretty significantly, and general and admin. So their revenue stayed flat. Their cost of revenue, they're making less profit from the cost of the item, whatever their service they're specifically providing. The direct cost of that service is basically being expensed under cost of revenue. The cost of providing the service, the programmatic ad service. Their costs have gone up very significantly. So that is by far the main reason this company isn't profit, or it's not profitable in the most recent quarter. But it's now losing money, and it's because of cost inflation. That's the problem. 100%. I can see it right now. The revenue's flat. That's great. But if they had kept their costs the same, they still would have been profitable. Okay. So it's not necessarily an environment thing, or if it is, it's only part of the problem. But another problem could be they're just not good at controlling their costs, because I see costs going up everywhere. Whatever. So they have the most recent quarter, they lost money right after the holidays. Shares up. Got it. Let's see. Accumulated, this is comprehensive. This is immaterial. It's basically gains and losses on available for sale securities show up here. And it's really insignificant. It's not like that bank that went under. All right, let's look at the statement of stockholders' equity. Okay, so we can see their common shares, right? So this is the amount of common stock they had outstanding. 108,000 shares were exercised for stock options, but they bought back way more shares. Okay, they bought back only 108,000 were issued, and they bought back 586,000. And then there was some more share issuance from RSU vesting. So overall, the share count from December 31st, 2022 to March 31st, 2023 went down. So even though some shares went out because of stock options, basically restricted stock units, they bought back more than they issued. So net on net, over the last 3 months of reports that we have, shares have gone down. So they are willing to buy back stock. And we can see that they bought back 586,000 shares for $7.898 million. So they paid, let's see how much they paid. Divided by 586,830. So they bought back shares for an average cost of $13.45. And the stock is, so they bought back the shares pretty cheap. Okay, not bad. Not bad, good sir. Let's see. Okay, additional paid in capital, net loss. Yeah, so basically their equity, the main change in equity was buying back shares. That's why equity went down a little bit. Okay. Let's see. Okay. Yeah, that's basically it. They're willing to buy back shares. That's what I get from that. Okay, let's look at the statement of cash flows. Depreciation, amortization, stock-based compensation is up a little bit, but nothing crazy. Accounts receivable is added back. So basically in a statement of cash flows, how it works is you start with net income, you add back non-cash expenses, you subtract non-cash gains, basically. And then you do adjustments for changes in operating assets and liabilities. So, for example, they're adding back accounts receivable because accounts receivable went down over the last 3 months. That means they theoretically collected cash. If accounts receivable goes down, you're reversing it out and you're collecting cash. So they add back accounts receivable. Prepaid expenses also went down, so they added that back. Accounts payable went down, so they subtracted that. That means they're paying off debts. Those are all the adjustments, okay? And that's how you get to net cash provided by operations of $12.7 million. So their net cash has gone down, but that's par for the course because now it's not advertising season, at least this last financial report. Let's see. So nothing crazy in here, to be perfectly honest. Stock-based compensation's up a little bit. Depreciation, amortization's up a little bit. But nothing crazy right there. Okay. Let's see. So they bought some PP&E. They're spending a decent amount. They're spending more on purchases of property, plant, and equipment and capitalized software development costs than they did for the prior 3 months for the prior year. So spending is up on capital assets. Most of their investment spending was putting their spare cash into investment securities and some maturities of investment securities. Cash flows from financing. Okay. They got some cash from their employees exercising stock options. Because remember, the employee has to pay a certain price for the stock options. And they're giving the company, PubMatic, money for the stock options. So that's why it's a cash inflow. Payments on finance lease obligations. That they're basically money they've paid on leases. And they, like we said earlier, they bought back treasury stock. They spent $7.8 million buying back treasury stocks, and they bought it for an average price of $13.45 per share. Okay? So at least they care about the dilution solution. All right? So overall, I mean, this company could easily recover, I think, when this whole ad industry disaster goes down. But the main things I've noted is, number one, they are buying back stock. That's interesting. That's basically it. They're buying back stock from the statement of cash flows. That's the main thing I got from that. Nothing else was like massively different. Their profits are down mostly because of expenses. It's because of expenses. Revenue's a little bit up from prior year, but their expenses are up way higher. They're having trouble controlling costs. Their balance sheet is pretty solid. They're not going bankrupt anytime soon, in my personal opinion. Okay. So overall, I don't know where this company's going to go in the future, but at the end of the day, it's not the worst thing in the freaking world. Okay. We can skim MD&A, management's discussion and analysis, business highlights, operating income, EBITDA, all garbage. Let's see what's going on here. So here is where you can get more detail about, what could have potentially happened with revenue slowing down. Let's see. Give me some data. Where's the information? Peekabo. We generate revenues from publishers to sell. We generate their fees. We report revenue and net. This gross billings to buyers, net of amounts we pay to publishers. We record our accounts receivable. Let's see. Okay, here's cost of revenue. This is interesting. Consists of data center co-location costs, depreciation expense related to hardware supporting our platform, amortization expense related to capitalized internally used software development costs, personnel costs, and allocated facility costs. Personnel costs include salaries, bonuses. So this is where the cost of revenue comes from. Okay, so these costs are up. Let's see, operating expenses. Well, these are more common sense. Okay, these costs are all up. Basically, all the freaking costs are up. It's a disaster. No, it's not the worst thing in the world. Interesting company. I've seen worse. I'm not saying this is the best 10x company in the world, but it's not the worst thing I've ever seen. Let's see. In the first quarter of 2023, mobile and video comprise 71% of our revenue. We anticipate mobile to continue increasing as a percentage of our total impressions and revenue in the future, bro. We further expect video to constitute an increasingly important component of our business. Okay, so a lot of their revenue comes from mobile ads. What's this? In March 2023, our platform efficiently processed 516 billion ad impressions daily. Oh my God. That is a lot of ad impressions. They always say that the average person sees 5,000 or 6,000 ads a day. That's insane, man. 516 billion ad impressions. Oh my. Ooh, baby. Let's see. We serve approximately 1,700 publishers and ad developers representing over 97,000 individual domains and apps worldwide across a diverse group of content verticals, including many leading digital companies such as Yahoo and News Corp. Wow. Their business is legit. They have a lot of customers and clients. They're just having trouble controlling costs. So that's that. All right. Hope you guys enjoyed the video. Let's see. Woo! Much less comments for this video. You started talking about penny stocks. This makes you buy the stock. It's going to 10x, bro. It's going to the moon. Boom, 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 boom. Now, if you want to pay me to be a penny pumper, you can click that link, send me $40, and I will make a video for you. Who's paying you to analyze these trash stocks? I cannot disclose the identity of my clients. Do you want the plain big? Do you watch the plain? No, I don't really watch him. I'm not saying he's bad. I just don't really have an interest. He talks about generic stuff, I think. Strawman, you want to make money, you got to start day trading, bro. Learn TA. YouTube crap is not. Are you serious? How am I going to day trade at my full-time job? I have a job. I work all day. How am I going to day trade? Did you cover the new release of Tattoo Chip? I'll get to that later. I'm trying to get through all these paid videos first. Tattoo Truckers Tight Taint. My favorite thumbnail. Did you like the hin and the hex symbol? All right, guys, that's it. You want a paid video? Click this link. Give me all your money. And let's see. Keep up. You're going to start to track Jeremy fans. Hey, the better they pay me than pay that freaking clown. I charge $40 for a video. $40. I'm not even lying. I'm just looking at the financial statements. You pay Jeremy so we can lie to you. You pay him $2-3 grand, freaking clowns. Go, keep doing that. Keep doing that. All right, I may pump out a few more videos, but that's it. Use algo. Yeah, just day trade, bro. Quit your job. Quit YouTube. Quit everything. Just day trade, bro. Okay. All right. Cheers.